It's Monday, May 3rd. Welcome to Market Foolery. I'm Chris Hill. With me today, Jason Moser. Good to see you.
Happy May, happy May.
Happy May. We have good news for market timers, and we have a media deal to discuss, but we are going to start today with Mr. Buffett. Berkshire Hathaway's operating income in the first quarter rose 20%. They bought back $6.5 billion worth of stock, and Berkshire's cash on the balance sheet grew and now stands at $145 billion. And all of that, Jason, took a backseat to comments that were made at the annual meeting over the weekend, which is that Vice Chairman Greg Abel, who runs all of the non-insurance operations at Berkshire Hathaway, is going to succeed Warren Buffett as CEO. And for those who missed it, this was not a formal announcement by the company. This happened during the Q&A when there was a question about how big Berkshire Hathaway has become, sort of the sprawling nature of all these different operations, and you know how are you going to, you know, is that more difficult to keep a handle on? And Charlie Munger responded by saying, Greg will keep the culture. Like basically when Warren and I are gone, Greg is going to keep the culture. And it's like, oh, well, I guess that's that then.
Do you think Charlie under his breath was like, damn it, I did not mean to say that. Sorry, Warren.
I think Warren under his breath may have said, damn it, Charlie, why did you say that?
Well, I mean, we've been talking about this. It seems like every year for this meeting, it's just kind of that question of like, who is the name? I mean, in hindsight, God, it seems like it was so obvious. I mean, just the name alone, he's quite able to handle the challenge. I mean, you know, we should have guessed. I guess we should have known is what I'm saying. But it is a little bit of a surprise because I think a lot of folks thought that Ajit Jain might be the name that ultimately would have been occupying that CEO suite. But it sounds like it's going to be Greg Abel, and I mean, Charlie and Warren know the business better than anyone, right? And I think again, it sounds like it would be a team effort, no question. But it is nice to get that certainty, right? I mean, now all of a sudden you have an idea of who they feel like is going to be able to keep this company going in the direction it's headed. I think it's a testament to their feelings on where the company is today and where they feel like it has the opportunity to go in the coming years. Because there's been obviously a lot of criticism recently, particularly with Warren and Charlie kind of being the old guys, get off my lawn, old school investing, and you guys aren't nearly as relevant anymore. They seem to think that what they're doing is still working, and they've got a team in place to kind of help keep steering that ship in the same direction. And frankly, I think that's the right call.
I think it's the right call as well. And I didn't realize that Greg Abel is 10 years younger than Ajit Jain. And obviously both of them are significantly younger than Buffett and Munger. But I do wonder if that, I'm not saying it's the deciding factor, but it's certainly, you know, if you've been running Berkshire Hathaway for as long as Buffett and Munger have, then whoever is going to succeed you want them to have as long a run as possible.
Yeah, I appreciate that. You want to set yourself up for success so you don't have to worry about this problem again for a long time, and it sounds like that will be the case. And I think, I mean, when you look at Mr. Jain versus Mr. Abel, I mean, I was reading something earlier in the Wall Street Journal on this that it described the differences between the two and kind of what they do and how they think and what they're focused on. And in regard to the business itself, Mr. Jain, who oversees the insurance business, he's not reading 10Ks. He's focused mainly keeping up on the insurance industry and analyzing the insurance side of the business, which is obviously a big part of Berkshire Hathaway, but it's not all of it, right? I mean, there are plenty of other aspects to the business, and that's where I feel like maybe Abel is the better person for this job because of the fact that he spends so much of his time focused on the bigger picture, it seems, not just insurance, but really focused on the competitive threats that are out there that Berkshire Hathaway is facing, not just from an insurance perspective, but from a sort of conglomerate perspective, right? I mean, this is a big business that does a lot of different things. And so it sounds like Abel is a bit more focused on that big picture landscape, and that I think probably benefits the company. And then the bonus there is it keeps Ajit Jain in place doing something that he's really good at, right? I mean, we have a long track record of Mr. Jain's performance there in what he's been doing for the insurance side of that business. So I think it really just keeps two people in place doing what they do really well, and that it sounds like is more or less your sort of modern day Charlie and Warren tandem there running the business, focused on obviously more than just managing the portfolios, but really focused on running the business at large.
You're going to be digging into this on Industry Focus later today, so we will move on from Berkshire Hathaway, but definitely for folks looking for more on Berkshire Hathaway, because there was a lot of stuff that we don't have time to get to. That check out Industry Focus later today. In 2015, Verizon bought AOL for $4.4 billion. In 2017, Verizon bought Yahoo for $4.5 billion. All of those properties became Oath, an unfortunate name that wiser heads prevailed, and then it was rebranded Verizon Media Group. And today, Verizon is selling its media group to Apollo Global Management for $5 billion, which is, less than $8.9 billion.
Yeah, I guess it is, isn't it?
When I saw this story this morning, one of my thoughts was, oh, that's right. Verizon owns both of those media groups. And it's, there are a couple of things we can get into here, but one of them, Jason, this is just from a basic strategy standpoint, this is Verizon very clearly sending the signal, hey, we tried this media thing for a while and it's not working for us. And we know that some of our competitors are still doing this, but we are getting out of this game.
Yeah, and so it's funny. This is a perfect segue, I think, because the quote that stands out to me in regard to this story is one from none other than Charlie Munger, when he said, and I quote, "Acknowledging what you don't know is the dawning of wisdom," end quote. And that's something we like to bandy about a good bit on the investing team in some way, shape, or form. It's like, listen, man, understand what you don't understand. Know what you don't know. Don't get in over your head. And time again, people, businesses, we all do it. I mean, it's human nature. We do it, and then we look back and we regret it. And hopefully we learn from it and we move forward. I think this is going to be one of those situations where Verizon looks back, they realize, listen, we tried something, it wasn't really in our wheelhouse, we didn't really know what we were getting into fully, because in hindsight, if you look at the competitive landscape now when it comes to ad tech and media, how in the world you think you could be going up against some of those incumbents as just like a landline and mobile operator is beyond me. I'm sure they're probably telling themselves that now. But hey, better late than never, right? And I think to your point, the amount of money that was invested in this part of the business in Verizon Media, formerly known as Oath, it was a, I don't want to say it was a dying business, but it was a shrinking one. I mean, if you look at 2019, Verizon Media revenues were $7.5 billion. 2020, they were $7 billion, and I think you could argue that was a pretty good year when they chalked up that $7 billion. It was continuing to get worse. When you couple the competitive landscape with what these operators, specifically Verizon and AT&T, and to an extent T-Mobile business, they have to invest a ton of money right now into this 5G rollout. Spectrum bid alone is really costing these companies a lot of money. And to put some numbers around that, recently the FCC, the Federal Communications Commission, announced that there was an $81 billion auction for that 5G mid-band spectrum. And the initial estimates were that it would be around $20 to $30 billion. It came in at $81 billion. Verizon was the big spender of that $81 billion. They bid almost $46 billion on that 5G spectrum. So they, I think, a while back decided, hey, let's focus on what we know and what we need to do, because when you weigh out the priorities, 5G in the subsequent Gs to come are far more important than them trying to build some kind of an ad tech business based on dwindling media properties. And so clearly they're going to have a lot of obligations here over the coming years in building this infrastructure out, in coming up with the capital to pay for it all. Focusing on this Verizon media side of the business just seemed like it was a waste of time, and it was becoming a waste of money. Unloading it makes perfect sense, and like I said, better late than never.
In the early days of the internet, it's almost hard to overstate how popular and dominant these two consumer businesses were.
It is amazing to think about, isn't it?
AOL's market cap at one point was more than $200 billion. Yahoo's was over $100 billion. So the fact that this combined entity at one point valued at $300 billion is being sold off for $5 billion, I think it is, among other things, a nice reminder for us as investors. Just always check in on the business, because there were people, and by people, I'll just name one, David Gardner. David Gardner did so well investing in AOL.
Yeah.
Back when it was first America Online, I think that might have been the first recommendation he made in the old Fool portfolio back in the mid '90s. And again, these were businesses that had tremendous runs, but competition is forever. And businesses that can't stay ahead of the competition end up like this.
Yeah, and I mean, it's a great reminder too. Content is really difficult on an ongoing and sustainable basis. It's just really difficult because you've always got, like you said, competition is forever. You have 1,000,001 channels out there now, and pretty much you're going to be able to find whatever you want at the click of a mouse. And I do feel like, I mean, I don't frequent Yahoo all that often. I will say the Yahoo of today is markedly different than the Yahoo of 7-8 years ago. I mean, I don't mean to come down too hard on it, but really, frankly, to me, Yahoo at this point just seems like a glorified version of the National Enquirer. I mean, I don't know when the last time you went to Yahoo was. But every once in a while, you end up there, and I'm looking through these. I mean, it seems like it's just catering to the lowest common denominator. And so, if you're doing that, you're making a bet. You're kind of saying, okay, this is what we're going to do, but that comes with consequences. And so, it's not surprising to me to see brands like Yahoo sort of on the way out, because when you look at what they're doing today, it's not terribly meaningful. It seems to be very clickbait driven, and I'm sure that was partly by design. I mean, when you're developing an ad business, you're trying to figure out how to get as many clicks as possible. Eventually, though, people really, they're gonna come and go based on what you're putting out there, and we've seen these two behemoths have been competed right out of their respective marketplaces, I think.
Happy first trading day in May for all you market timers out there. This is this is the day where the old adage "sell in May and go away" gets trotted out. And every year I just shake my head at this. That there are people, some of whom are presumably serious people, who take this to heart, and this is their strategy for investing.
For whatever reason, those little one-liners get a lot of attention, and I mean they sound almost like, it sounds almost like you're hearing it straight from Troy McClure on The Simpsons, right? I mean, it's just like, seriously, like what why, right? And I guess it's just the going wisdom is that from May through October, you've got your bankers taking vacations and there's no real buying going on, so people just kind of sell and then they go off for the summer and do their thing until they come back for the fall. And I mean, maybe there is something to that, but I mean, at least the numbers would tell you that it might pay to stay invested. I mean, there was some very interesting data that I found from LPL Research and FactSet that looks back to 2011. And if you go back to 2011, the 10 years that follow from 2011 through 2020, of those 10 years, if you look at the window from May through October, right, the sell in May, or maybe it's May to October, I'm sorry, but if you sell in May and go away, in those 10 years, only 2 of those years were returns actually negative, right? The other 8, those returns were positive. In 2020, I mean, let's think about 2020, right? I mean, at the time, in March and April, it felt like the world for investors was coming to an end because it was this precipitous bear market that hit us. No one would have ever thought, based on the research that we had done, that it would recover so quickly, and yet here we are. Can you imagine not being invested between May and October of last year? Can you imagine not buying stocks during that time? Because I guess I can imagine it, but I choose not to because I'm really glad that we didn't sell in May and go away, because the returns last year for that window were 12.3%. And to me, that sounds like a time where you actually want to be invested. And so there's clear data that says you probably shouldn't sell in May and go away. I think maybe we alter this, we change it around a little bit and say instead of selling in May and going away, maybe you just don't sell anything. And if you're really tied to not, just don't buy anything. Like if you really feel that strongly about it, because the problem with selling is once you do that, you're hitting the reset button. You're foregoing all of the benefits that you gain from being a long-term shareholder, the compounding, the growth, the gains. You couple that with tax liabilities, potential tax liabilities that may exist. I mean, it seems like there are more reasons to not sell than there are to sell.
Yeah, I'm glad you mentioned taxes, because that's another part of this that I just can't get my head around. that like part of my investing strategy involves choosing to pay higher taxes. Like, why? Yeah, exactly. And I mean, like, it's one of those things that's always going to exist, right? You have to consider it. I mean, if you're working with an account that's tax exempt, I mean, an IRA, something like, you don't have to worry about that. But still, I mean, just look back at the actual data. I mean, again, of those 10 years, 2 were negative, and of those 2, I will say, 2011, the return in that window was negative 8.1%, but the other negative return, it was negative 0.3%. So it was essentially flat. I mean, we're rounding that up to flat, Chris. So, I mean, the numbers tell you should probably not sell in May and go away. Inevitably, some people will do it. We're just going to spend the next few months, hopefully, Chris, telling people why they shouldn't. Jason Moser, great talking to you. Thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.